Welcome, everybody. This is Steve Gorin. Thank you for joining my webinar on landmark tax court self-employment tax decision, post-mortem planning for business owners, and reimbursing deemed owner of Grantor Trust. Basically, some topics from my first quarter 2017 newsletter, and I have a few bonus items in there too. This CLE program is certified, and CLE certificates will be sent once we verify attendance. If you are seeking CLE for this webinar, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in the verification form included in the login instructions sent to you. All CLE questions should go to CLE-TC at Thompson, THOMPSON, Coburn, COBURN.com. Login is proof of attendance and supports our awarding CLE. If you need to leave the webinar, you should log out and then log back in when you return. Welcome. Going to the next slide, and we have an overview of what we're going to be talking about. And we're going to talk about a very important tax court employment tax decision. And in fact, there have been several developments since then, and I'll briefly mention those. So this first part is going to take more than half of the time. Then we'll talk about post-mortem planning for business owners and some tricks you can use when you have an S corporation that you solely own. And then we'll conclude with some private letter ruling on reimbursing taxes paid by the deemed owner of the Grantor Trust. So in the next slide, the code word is landmark, because we have a landmark LLC case. First, I'm going to just briefly review about self-employment tax and LLCs, and then review some cases and an IRS chief counsel advice. So self-employment tax is, again, that's 15.3% on the first roughly $120,000, $130,000 of earnings, and then after that it's 2.9%, so you get up to about $250,000, and then after that it's 3.8%. And there was some thought that this supplemental bump up from 2.9 to 3.8 might get repealed along with the repeal of the Affordable Care Act, but that hasn't happened, and nobody really knows whether it will happen or not. So I think we can just plan on it being around for the indefinite future until we see some developments. But just a reminder, the big issue here is that limited partners do not have to pay self-employment tax on their distributive share of income from the partnership. So if they receive guaranteed payments for their services, they need to pay self-employment tax on that. But if you're just talking about their portion of the partnership's profits, they are not required to pay self-employment tax on that. And again, that's just for limited partners. And the Ringemeyer case addressed what happens when you have a general partnership that has registered for liability protection as a limited liability partnership. And by definition, they're all general partners, and they're not limited partners. And just because they have limited liability doesn't mean that they're limited partners. And that's what the tax court held. And so that's the law for limited liability partnerships. I'm going to skip over the CCA. There was a case called Methvin, tax court case that came out in the past couple years, and in that particular case, the taxpayer had an undivided interest in working oil and gas project, and the percentage was very small, maybe 2 or 3%. And that person had no rights whatsoever to participate in management of this oil and gas interest. Now, this was, again, an undivided fractional share, so there was no business entity formed. And the taxpayer said, hey, I'm just like a limited partner. I have no right to participate, and I don't participate, so you should treat me like a limited partner. And the tax court said, nonsense, self-employment tax has nothing to do with your participation. It only has to do with what type of interest you own, and you didn't have an entity here. You were not a limited partner, so you're going to be deemed with self-employment tax, even though you had no right whatsoever to participate. Now, the big landmark case that came up, this Hardy versus Commissioner, Tax Court Memo 2017-16 that I wrote about in my newsletter. That particular case involved a doctor who was one of 8 doctors who had interest in a surgery center. And the surgery center was inside a limited liability company, and it was a manager-managed LLC, but all of the members were managers. So Dr. Hardy had a 1/8 interest in this LLC, and he also had a 1/8 vote in what went on with the LLC. Now, the tax court asked, well, you know, who manages this? And Dr. Hardy said, well, there's a professional person who runs everything. I just attend investor meetings. Actually, he didn't say that, but his lawyer did. So Dr. Hardy just attends investor meetings, and he doesn't run it on a day-to-day basis. And the tax court said, okay, you're passive, you don't do anything here, we're going to treat you as a limited partner. Now, one of the very interesting things in that case is the IRS during the trial asked, well, you know, what about Dr. Hardy's right to control? And, you know, because if you think about it, the limited partner exception, a limited partner is not supposed to have a right to control. And the tax court judge at trial cut off the IRS and said, didn't you hear us? Did you hear the testimony? He didn't control it. And so the tax court judge did not listen to whether there was any particular right to control or not. He didn't seem to care and found in favor of Dr. Hardy. So the tax court didn't have really any analysis at all. It talked about the Enrico Meyer case and acknowledged that as controlling, but because Dr. Hardy did not participate in the day-to-day running of the business, the tax court said in the discussion, I'm not going to treat you as subject to self-employment tax. So the Hardy case is really inconsistent in many ways with the Methvin case. Dr. Hardy had the right to vote, had the same right to control as any other owner, but he didn't have self-employment tax. Methvin didn't have any right to control, didn't have any say-so in what went on, and both Methvin and Hardy did not participate in the management, and yet Methvin was subjected to self-employment tax. Now, both Methvin and Hardy were tax court memorandum decisions, so they were, which means the opinion was circulated within the tax court, and the tax court judges didn't really see fit to comment. Nobody really kind of disagreed strongly with what was going on. They just didn't really see fit to comment on it. And so it's not a full tax court opinion where everybody's kind of blessing it, and it's certainly not a review decision. So these don't have much precedence or weight, but you can still cite them. So if you do have a passive investor in an LLC who's just a member, then Hardy would let you take the tax reporting position that you don't have to pay self-employment tax on it. Now, if you structure it that way, will you win? You know, I don't know. Depends whether you have a tax court judge who actually looks at your legal rights to control. So if you roll the dice and you get the same judges in the Hardy, then you'll win. Otherwise, you really are gambling on what the result would be. Now, after I prepared my newsletter and before the seminar, there was another case that came out, and that's the Castigliola case. C-A-S as in Steve, T-I-G-L-I-O-L-A, and that's Tax Court Memo 2017-62. And this was another LLC, and this was a member-managed LLC. So, like Hardy, all of the members had equal rights to participate. Now, in the Castigliola case, there were only 3 lawyers who were members. So they each probably, I don't know what their interest was, but you know, presumably they might have had a 1/3 interest compared to Dr. Hardy's 1/8 interest. The difference is that in the Castigliola case, there's 2 differences. One is the actual participation, and the other is the judge. So in terms of actual participation, in the Castigliola case, the 3 members were lawyers, and they worked full-time in the business. And again, our big precedent on this case was the Rankemeyer case, and in that case, it was lawyers who worked full-time in the business. So it's no surprise that faced with lawyers who work full-time in the business, that the tax court would say, yes, you have to pay self-employment tax. Now, the Castigliola case did take a very careful approach and tried to take another argument that another taxpayer made unsuccessfully. And here's what they said. We paid ourselves compensation for our services. We went out and we got survey done about what lawyers are paid. And we got paid on a Form W-2 like employees. So we were just like employees, and so yes, we know we had to pay employment taxes on that, but the distributive share, that really came from everybody else's work. And you shouldn't make us pay self-employment tax on everybody else's work. And Judge Paris says, well, that's all well and good, but first of all, you're not supposed to give yourself W-2s. When you're partners in a partnership, you get what's called guaranteed payments, and you get a K-1. And yes, that's subject to self-employment tax. Now, the IRS didn't complain about you getting W-2s instead of paying self-employment tax because they got the same amount of FICA anyway, roughly. So the IRS didn't really care, and they didn't make a big deal about it, so we're not going to make a big deal about it. But you were absolutely wrong to give yourself a W-2. Now, as an aside, there is some momentum where by tax professionals to ask the IRS, well, will you please maybe change the rules and let us give W-2s? And the IRS is studying it, but the IRS has not changed the rules. And there is a revenue ruling that says partners cannot get W-2s. That revenue ruling is still out there, and the judge said that's still good law. So taxpayers, you were wrong. We're not going to penalize you for it because IRS didn't ask us to. But when you say we were just W-2 employees, no, you were partners. You were active in the business. But the judge didn't just do this gut reaction feeling like the Hardy tax court judge did. Instead, the judge went down and said, okay, let's look at the exception for limited partners. And again, this was Code Section 1402, parentheses A, parentheses 13. And the judge said, well, Rinkemeyer told us that you don't have to just be a limited partner. We can look beyond it to see whether you're the same as a limited partner. So they noted that there's no statutory or regulatory authority that defines what a limited partner is, and therefore the term is to be given its an ordinary meaning at the time of enactment. Then Judge Paris went through and cited kind of chapter and verse on how the Uniform Limited Partnership Act has changed over the years. How was it to begin with? How was it when they enacted 1402A13 exception? How is it now? And so she went through all of that, and then she pointed out a limited partner has two classes of partners, general and limited. General partners have management power and typically have unlimited personal liability, although we know that if you do a limited liability partnership registration, or what we call a triple LP, a limited liability limited partnership, the general partner would not have unlimited personal liability. But they have management power and unlimited personal liability. On the other hand, limited partners typically lack management power and have limited liability. And then the judge goes and she talks about, well, you know, common to the definition of limited partner is not only limited liability but lack of control. In this particular case, each member of the LLC was a manager, had management power, and the three of them all participated in collectively making decisions regarding their distributive shares, borrowing money, hiring, firing, paying employees. They supervised the associates who did the work. They signed the checks, and so there's no way that they're limited partnership interests. They don't look at all like limited partners with all the work that they're doing. Judge Paris went and also added a little bit of common sense here. In a limited partnership, you have to have at least one general partner. That's a requirement in the law. So the whole limited partner statutory scheme envisions having somebody who has control. You cannot have a headless horseman, okay? You can't say, well, nobody is in control. In a limited partnership, somebody is in control, and you have to look to see who is in control. And here we had the three people in control, and so we're going to call them to be like the general partners. So there is no such thing as a headless entity. And I think that if the Hardy case had been in front of Judge Paris, I think there very well might have been a different result, because she would have recognized that you have to have somebody who has management rights as an owner. And so I think that she might very well have counted Dr. Hardy as having been a general partner instead of a limited partner. But we don't know. I mean, Dr. Hardy did not participate in the day-to-day management the way that they did in the Castiglio case. So we don't really know how that would have come out. But so basically, if you're doing a reporting position and you want to go ahead and, if the person is not active, then go ahead and report using Hardy and see whether you can get away with it. But from a planning viewpoint, if I'm planning in advance, I would rather walk like a duck and talk like a duck to be a duck. And so I would rather be a limited partner in a limited partnership. And the legislative history to 1402A13 says that you can be both a general partner and a limited partner, and you will have to pay self-employment tax on your general partner distributive share and any compensation you receive as a limited partner, but you don't have to pay self-employment tax on your distributive share as a limited partner. the legislative history is very clear about that. And I feel pretty comfortable that if the tax court had in front of them somebody who was both a general partner and limited partner, they would look at that legislative history and they would let you escape self-employment tax on your distributive share as a limited partner. Now, not everybody is as comfortable as I am because the Rankemeyer case had some very sweeping language in it, but that language was dictum there. So I still believe that people should go to have be limited partners. Now, the last bullet point of this page is the Fleischer case, and the Fleischer case. By the way, I just had a blog about Fleischer. It went out today. So if you go on to my blog page, which is referenced on the last slide of my materials, it's also referenced in my newsletter. If you go to my blog page, you can see a write-up on the Fleischer case. Now, the Fleischer case was not an LLC. It was an S corporation case. And the taxpayer was a financial consultant. At least he's the one who earned all the money. And when he went to go and sell life insurance or do investment management services or whatever, he had the contracts directly with the insurance company or the broker-dealer or whoever. And then what he did is he took his receipts and deposited them in his S corporation. And he treated it as if the S corporation had received all the earnings. And then he said, hey, this is S corp income. This is a distributive share. And so you shouldn't count it because S corporation distributive shares are not subject to self-employment tax. And the tax court said, and rightfully so, nonsense. You earned the money. Just because you paid it to your S corp, that's assignment of income. You earn the money, and trying to put some money into the S corp isn't going to really help you avoid self-employment tax. So you are subject to self-employment tax, and we are not going to let you avoid it. So too bad. Next time, make sure you get your contracts with the right, run through the S corp. And he said, yeah, but it would have been really expensive for me to do that. And the tax court is like, well, that's your problem. That's how you're doing business. So I also want to mention to you that there is a new program manager technical advice that just came out in the past week, and the IRS has had a couple cases in the tax court where it said, the taxpayers, you were S corp owners, you were shareholders, you called payments you received distributions instead of compensation, and if they were just distributions, they would have been your distributive share, and they would not have been subject to self-employment tax. If they're compensation, they're subject to FICA, and so the corporation and the individual rendering the services would have had to have paid FICA on it. So basically, the IRS has for many years been trying to recharacterize S corp distributions as compensation and imposing FICA tax on it. And so the question is, well, can the taxpayers contest that in tax court? And the IRS has secured 2 dismissals of tax court cases. And I'll give you the citation for this program manager technical advice. P as in program, N as in manager, T as in technical, A as in advice. PMTA 2017-05. Again, PMTA 2017-05. And so the IRS is saying, taxpayers, you can't contest our decisions about subjecting to FICA tax and other employment taxes your S corporation distributions. So presumably, they can go to pay the tax and then go to district court and sue for a refund. That there wouldn't be a jurisdictional bar for that. Would be my initial guess. I haven't researched it, so I don't really know. But that's just my initial guess. One of the cases that the PMTA cites in the Azarian case, A-Z-A-R-I-A-N, again A-Z-A-R-I-A-N. The Azarian case, the IRS was able to get the corporation dismissed, and the individuals who had to have essentially they're getting tagged with additional FICA tax. Those individuals have now gone to tax court, and I haven't seen the petition yet, but I would guess that they're going to try to argue before the tax court that, hey, you wouldn't hear the corporate case, but this is different. This is my my employment tax liability. I have to pay it myself. So I think that they may be going to try to kind of do a backdoor and try to get at least the employee's share of FICA back. So I will be including this in my next newsletter, but since it's hot off the presses, I figured I'd mention to you now. So let's go to the next code, which is premature. And it's premature to rely on the Hardy case, as I mentioned, particularly after we have other cases that have come out. So that's our second code word. We're shifting on now to post-mortem planning issues for business owners. So first of all, you can see the first bullet point, issues when those receiving the business after death or trust termination do not receive the residue of the estate of the person paying taxes before death or trust termination. So let's give an example. Let's suppose that dad left a Q-tip marital deduction trust for surviving spouse with the remainder to the kids. Only the surviving spouse is from his second marriage, and the kids were kids from the first marriage. So as far as the kids are concerned, stepmom is the evil stepmother, the gold digger. And as far as the surviving spouse is concerned, the kids are the ungrateful, greedy kids, okay? So let's suppose that the marital deduction trust owned S corporation stock, and it made a QSST election, Qualified Subchapter S Trust, QSST. Now, when you make a QSST election, the beneficiary is taxed on the S corporation income that flows through the trust. So if the surviving spouse made this QSST election, which would save income taxes on an ongoing basis, and that's a great reason to make a QSST election, to save the income taxes. So when she makes the QSST election, and she's going to be taxed on the income taxes. Now, let's suppose that mom died on January 31st, 2017. Not mom, I'm sorry, surviving spouse. January 31st, 2017, she died, okay? And on her return, she's going to have to include all of the 2016 income as well as a sliver of the 2017 income, okay? But the S corporation makes its 2016 tax distributions in April when its shareholders' taxes are due, okay? So now after stepmom dies, the ungrateful kids get all the distributions. So when the tax distributions are being made in April of 2017, the ungrateful kids get the tax distribution that was intended to pay mom's 2016 taxes. Now, do you think that the stepkids are going to give stepmom the money to pay her taxes? I doubt it. Could be. They might. But I doubt it. So there's a potential danger there whenever a beneficiary makes a QSST election that their estate might be short on luck. And so you want to consider it whenever you make a QSST election. And think about when you draft an estate plan. So what are some of the things that could have been done? Maybe when stepmom made the QSST election, maybe she entered into an agreement with the trustee that says that the trustee agrees and binds the beneficiary, their successor beneficiaries, that any post-mortem distributions will pay her taxes. Think also about when Dad drafted this trust. I mean, he could also have provided for that if there is a QSST election in place, he could have provided in there that the trustee can't give the money right away to his kids, that they have to pay his surviving spouse's taxes first. So, similarly, if you have a partnership interest, you may have some similar issues. The QSST is probably the most likely issue. Another could be a grantor trust issue. Suppose Dad sets up an irrevocable grantor trust during his life, and when he dies, it passes to the kids. And on Dad's final return, the income is included. Suppose Dad is remarried and the residue of his estate goes to his second wife. So in that case, as a grantor trust, Dad's final return is going to have to pay those taxes. His estate's going to have to pay the taxes. So that's going to come out of the money that otherwise goes to the stepmom. And so again, you have the same problems as with a QSST. So think about whenever you have any grantor trust, whether it's a grantor trust, a traditional one that's taxed to the grantor, or whether it's a QSST that's taxed to the beneficiary. In either case, being mindful of how those income tax distributions are going to go. Okay, the second bullet point on that page has to do, in particular, with S corporation stock. Okay, so suppose you have, Dad owned the money in a revocable trust, and that's where his S corp was, and on Dad's death, maybe it goes to a marital trust for the surviving spouse, or maybe he's not married and it goes to trust for the kids. But during the first couple years after death, the trust is not required to make any kind of election. The trust can just pay taxes on the S corporation's income. The problem is that the trust might very well be paying taxes at a high rate, maybe much higher than the surviving spouse's rate, maybe much higher than the kids' rates. So even though for a couple years after death, the trust could hold on to that stock, even though it's permissible to hold on to that S corporation stock, that may come with a hefty income tax bill because the trust might be taxed at a much higher rate than the surviving spouse or the kids. So one thing that you might want to consider with that is whether you might want to do a quick funding. So let's suppose we have a surviving spouse. Suppose it's a first and only marriage. Everything goes in trust for the surviving spouse. We know that we could take the unlimited marital deduction when Dad dies, and we can totally avoid estate tax. And we would like to have mom's brackets be used, you have the income tax to her. So dad dies on day 1. As soon as possible after dad dies, go ahead and fund that marital trust. Put the S corporation stock in it, and have have mom make the QSST election. So you would only have a very short period of time after dad's death where the income is taxed at the trust level. And then from then on, once it gets into that trust, then the surviving spouse will be paying those income taxes. Now, the same could apply too if you have, suppose it's going to the 3 kids. They each have their own trusts. You could do a quick funding of those and then have the kids make the QSST election and get the full run-up in the brackets for the kids and get it taxed at a lower rate. Now, if you have a relatively small estate, and of course the word small has changed a lot. It used to be that small was a few $100,000 or maybe $1 million. Now the word small is $5 million because we have a $5 million exemption. So if you have an estate that's well under the exemption, then doing this quick funding is potentially a really great idea, and so I would tend to move fast on that. Now, what if you have an estate that's subject to estate tax? Well, then you really need to think long and hard about it, because the executor of the estate is going to be personally responsible for paying the estate taxes to the extent that the executor lets money leave the trust. So you have a revocable trust or you have an estate. If you just hold on to everything inside the estate, wait until you get the estate tax closing letter, wait till you know the estate taxes are paid, then the executor is never going to have any personal liability. But if the executor will make a fast distribution and pay before everything gets resolved, the IRS can go after the executor personally. So the quick funding would be a good idea to save income taxes, but it might be a very bad idea from an estate tax perspective. So at least from a personal liability perspective. So the executor should really think long and hard before doing that quick funding. Maybe raise the issue, maybe seriously considering, maybe do the funding and take protective measures, or maybe they just say no way. Okay, so tax allocations on the change of interest in a business. We already talked a little bit about there can be a dichotomy between when the tax distributions are made and when you're paying the tax. But the other thing has to do, and you can see on slide 6, I'm referring to in my first bullet point, Roman numeral 3B2L, and so you'll see in the program materials there's at least in my newsletter. There's a link to my materials, and so if you went into my materials and you typed in that 3B2L, and then you'll be able to go to it pretty quickly and find it. So what we talk about there is, suppose you have, for example, an S corporation, and then we have, and suppose we have Jane, and Jane dies, and Jane dies on June 30th. Okay, so half of the year would be taxable to Jane's estate. To Jane personally on her individual return, and the other half would be taxable to the estate. Now, it could be that you might want to have one person pay more income tax than another. Like, for example, if there's a way that we could shift income to Jane's final individual income tax return, and her final return included higher income, then her final return would have higher income taxes. Those higher income taxes would be a liability on the balance sheet, so to speak, on her personal balance sheet that would be a deduction for estate tax purposes. So if we could shift income to Jane's final return, then we might be able to pay less estate taxes. Now, on the other hand, it might be undesirable to shift it to Jane's final return. Suppose that Jane was in a second marriage, and she was leaving all of the assets in her estate to her husband, Harry. But the kids got a specific bequest of the S corporation stock or the partnership interest or whatever. Just say S corporation stock, okay? So it may be that we'll come up with the same problem we had before, where if we shift the income tax to Jane's estate, that's going to come out of the money that's passing to Harry, but the tax distributions go to her kids. So in that case, shifting income to her individual return would not be a good idea. So based on facts and circumstances, it may or may not be a good idea to try to play games and try to shift income. Now, how can you shift the income? So for an S corporation, the default rule is that each shareholder gets allocated the S corporation's items pro rata, per share, per day. So in our example, when Jane died halfway through the year, Jane is going to get half of the income allocated to her personal return, and half of it gets allocated to the estate's income tax return. Now, there's an option to do an accounting cutoff. And what can happen is the estate can agree that they're going to do an accounting cutoff, and you look, what was the income on June 30th? That's the portion of the income that gets taxed on the final return. And the balance of the income that's earned after that will get taxed on the estate's income tax return. So when will that make a difference? Well, what if there's an extraordinary item? What if there was a ton of income that came in at the beginning of the year? Well, so then you have a choice. Does that ton of income get split 50-50 between the individual return and the estate's income tax return? Or do we do the accounting cutoff and have that whole slug of income taxed on Jane's final return? Similarly, there could be a big taxable event that might occur in the second half of the year, and then you would have the option, okay, does that big slug of income at the end of the year get taxed to the estate on the estate's income tax return? Or can we allocate half of that on Jane's final income tax return? So we have some options here. And similarly, you have some options with partners. Now, the S corporations have different rules than the partners, and I just commend that to your reading in those materials. Another option, the second bullet point on slide 6, talks about inside basis step-up. So what do I mean by this? So when you have an S corporation or a partnership, the basis in your S corporation stock or your partnership interest, that will get a new tax basis on your death if it's included in your estate. However, what about the partnerships or S corporation's assets? Okay? So the basis of those assets, the assets inside the entity, we call that the inside basis. Do the assets inside the entity get a basis step up when the owner dies? And the answer is generally no, because what's included in the estate was the stock or the partnership interest, not the S corporation's assets, not the partnership's assets. So the normal rule is, no, there's no basis step up when the owner dies. Now, if you're a partnership, you can change that. The partnership can make what's called a Section 754 election. And again, it's all in the materials. If you look in that bullet point, Part 2Q8E3, it's all in there. And so the partnership can make a special election to get an inside basis step up on the assets that correspond to the decedent's ownership interest. Now, an S corporation cannot do that. And now I'm going to go through some slides in a moment that will talk about how you can do that, but I'm not going to go through those slides quite yet. Okay. Before I do that, I want to point out that there's basis step up. There's also the possibility of basis step down. You know, what goes up can go down. And so if you don't have a 754 election in place, that might be good. And let's stay on slide 6 for now. And what happens is that if you don't have a 754 election in place and your assets have gone down, then you might not get a basis step down. But the problem is if you have an unrealized loss inside the partnership of more than $250,000, then there's an automatic basis step down. So one thing that you might want to do to avoid that automatic basis step down is to sell the assets inside the partnership, take your losses now, and then you can get the income tax benefit from it. And then when you die, you don't do the election, you don't get a basis step down. The 754 election needs to be done for the partnership return that includes the year of death. So if somebody dies sometime in 2017, the 2017 partnership return that's filed in 2018 needs to have an election made. So there is an opportunity to make a late election. There's an automatic relief for a 1-year extension of time to file for a partnership return. But what happens if you miss that election? You know, you blew it. And now you're a couple of years into the administration, and oops, we didn't make a 754 election. Well, it turns out you have a second bite of the apple, because after you finish your trust administration and then you go and distribute the partnership interest, you can make the election for the distribution. So when you make the distribution from the partnership, have the partnership make the election on the return that includes a year distribution, and that can take care of that. Another issue that we have is when you have the deemed owner of a grantor trust who dies, you got to get a new tax ID for the grantor trust. And you're not allowed to use the prior year exception for your quarterly estimated tax. So you die, you know, the person dies on, November 30th, 2017. All of the first 11 months are the decedent's income tax return. The last month of the year is going to be a new tax ID, and there's not going to be a prior year election. Actually, be a little bit more stark. If the person died on January 2nd of 2017, they'd have to make estimated tax payments for all of the January 3rd through December 31st, 2017 taxes. That would be for a trust. Estates don't need to pay estimated taxes, nor do revocable trusts. So it would really only be an irrevocable grantor trust you have to worry about. Partnership versus an S corporation, we already kind of talked about the inside basis step up, outside basis step up. We talked about that the partnership you can do a tax election. And then are you able to do something similar to this for an S corp? Suppose you have an S corp and it's got a piece of land with a zero basis that they bought it umpteen years ago. They don't have any basis records, a zero basis. The land is worth $1 million, and the decedent owned 100% of the S corp. So when the S corp sells the land for $1 million, it has no basis, so there's going to be $1 million basis on a gain on this K1. And so there's going to be $1 million of income showing up on the estate's income tax return. Now, when the decedent died, the stock basis got a basis step up to $1 million. That was the value of the 100% of the S Corp. And then there was $1 million gain on the K1. So the basis after the sale of the real estate is now $2 million, which is the sum of the $1 million stock basis at the S and the $1 million gain on the K1. So $2 million basis. Keep that $2 million in mind. When the S Corp liquidates, there's $1 million that comes out, but the stock basis was $2 million. So $1 million sale proceeds minus $2 million stock basis, $1 million loss on liquidation. The long-term capital gain on the K1 was $1 million. The long-term capital loss on the liquidation was $1 million, and so they offset each other. You have to liquidate the S Corp in the same year in which you sell the property in order to get this benefit. Furthermore, what if you sell some property and you don't sell the rest? Do you still liquidate? Well, maybe you do, maybe you don't. If the property is just land, then yeah, go ahead and liquidate. If the property is depreciable property, however, then the liquidation, any of that property was still left in the corporation at the time of liquidation. If it's depreciable property, that will be ordinary income on the liquidation. And that ordinary income cannot be offset by the capital loss. So you would have a mismatch there. So a sale, if you have depreciable or amortizable property, you'd want to sell to a third party. Furthermore, there's a state income tax disconnect. Suppose I have a Missouri estate, and it owns a Missouri S Corp that has land in Illinois. For federal income tax purposes and state income tax purposes, we can have an offset. However, for Illinois income tax purposes, where the land was sold, the loss on liquidation is not Illinois source income. The loss on the liquidation is a Missouri estate, it's a Missouri corporate stock, that's all sourced to Missouri. So for Illinois purposes, you don't have the offset. So S Corp is still worse for state income tax purposes. So the code word for here is reimbursed, and this relates to, we talked about reimbursing taxes before. Reimbursing taxes paid by the deemed owner of a grantor trust. So the deemed owner, you have an irrevocable grantor trust, and the person got tired of paying income taxes, and lo and behold, the grantor was not able to turn off the grantor trust powers. Now, that typically will not be the case on a trust I draft because I'm big on giving the grantor that control. But there is that possibility. There's also an issue if you have a GRAT, you can't turn off the grantor trust powers during the grantor trust term. I typically put in my GRATs that if the income taxes exceed the GRAT annuity, that there's an income tax reimbursement. But there was a particular case where the grantor had put in the assets and they weren't able to turn off the grantor trust power, and there was no grantor trust reimbursement clause. And by the way, if you put in a grantor trust reimbursement clause, then that reimbursement clause could very well cause the trust to be included in your estate if you die within 10 years of forming the trust. Why? That's because the Bankruptcy Abuse and Prevention Act of 2005 says that if you create a self-settled trust and you get sued, your creditors are allowed to go after any distributions that could have been made to you. And so by operation of that law, there may be a state inclusion if you die within 10 years of putting that clause in there, or at least if you start off with that clause. Now, on slide 15, we have this letter ruling, 2016-47001, and that letter ruling, there was no reimbursement clause, but the parties decided it was desirable to have one, and then what happened is the beneficiaries consented to adding a reimbursement clause. Well, why would they consent? Well, if the trustee is going to like decant the trust and into a trust that gives a reimbursement clause, well, here's a trust where the grantor was paying income tax that was benefiting the beneficiaries. So the beneficiaries could sue the trustee by saying, look, before the grantor was paying my taxes, now the trust has to pay the taxes. So now you've gotten rid of that valuable benefit for me, and so you've done something wrong. So the beneficiaries consented to turning off the to the reimbursement, and so the question was, is that a gift by the beneficiaries? Now, from my perspective, I would be very concerned that it was a gift. But the IRS in a letter ruling said, no, reimbursement, that deals with paying taxes, and so we're not going to count that. That's administrative. We're not going to count that. I have a July 11th webinar from my second quarter newsletter. I have a blog, Business Succession Solutions. You can click on that link there, and that'll take you there. There's also a report from Hector link that I send out every year. You can go ahead and do that and click on that. So I encourage all of you to subscribe to these additional things. And be sure to check out my blog. It'll mention the Fleischer case on the S-Corp. And I do plan on doing an article on that new PMTA about the not being able to contest recharacterizing S-Corporation distributions as wages. So I'm not seeing any questions. I'm going to go ahead and end it. I hope that you, again, sign up for my things and set aside July 11th on your calendar, and I hope you found this to be useful. If so, let your friends know. Thank you very much, and have a good day.